People's borrowing capacities have been slashed. There's been 13 interest rate increases in the last 2 years, and that's taken its toll. Banks always add a buffer to the interest rate that they offer. So traditionally, that's always been 3%, and that's still in place now. So, a few years ago, banks were calculating repayments for borrowers at around 5.5%. That's now in the 9s and 9.2. With the cost of living going up, banks have also looked at their minimum living expense measure, and that's also increased. So those two combined have really pulled people back.
Welcome to this new episode today, where we're chatting today with Melissa Cavers, a mortgage and finance broker and director of Maplefly Money here on the Central Coast. Melissa is an experienced mortgage and finance specialist with a long and demonstrated history of working in the financial services industry. With a Bachelor of Economics, Melissa provides skilled, specialised advice to homeowners in leveraging equity for a better financial future, and also guiding first home buyers through the complicated journey of obtaining finance to purchase a home. Melissa is renowned for thinking outside the box when it comes to finance and has helped so many of our clients achieve their goals. We're really excited to have such a wealth of knowledge here today to share her wisdom and advice. Welcome, Melissa.
Well, thank you. Thank you for having me. I'm very excited to be here. Listening to the podcast, so yes, nice to be on as a guest.
Thanks for listening. We love that. Tell us, I guess, for our listeners a little bit more about you. We met you a number of years ago through a client, actually, who you knew from your Sydney days. And, we're just so impressed with what you offer our clients and many others and us personally. And, share a little bit about you and what you do.
Yeah, well, thank you for those kind words. I guess I started my career in having finished my economics degree, having come out of uni. I was straight into wanting to work in a bank and fell into some compliance and risk type roles, which taught me a lot, and I developed a lot of skills in that time and learned a lot about banking. It was through that, though, that I realised that whilst I was learning a lot and developing those skills, I didn't have a sense of purpose or fulfilment. I was dealing with systems and processes rather than people, and that's not a direction I wanted to go into. So straight away I knew, okay, this is not going to be long term. I did end up moving into the community housing sector for a while in similar roles, and it was there that I really had eye-opening to really the problems of the public housing system, the rental crisis, and also just the impacts of housing, the great issue that housing was in the economy and still is today. And that's what I really thought, okay, well, this is, having that knowledge and bringing all that together, I thought, this is really something that I want to sort of explore further in a different capacity and not in a risk and compliance role. So it was actually a friend who needed some help buying their first investment property. And she was really struggling with just, well, how does this actually work? How do I get started? She sort of needed a greater level of support that she was able to find through traditional banks and just having that transactional type approach. She really wanted to understand the process, the loan structure, what would be best for her situation. And so when I was on maternity leave, I had some time to ponder and think about what would be next. And so based on, the banking experience I had and my desire of working with numbers and helping people, mortgage broking seemed like a really good next step, and Maplefly Money was born in a way from that point on.
That's a great journey. Yeah, and you add so much value, and you've helped so many of our clients. We often get feedback, and the feedback is that it's not just about putting in an application for a loan, like you actually add
and just doing what you think you're supposed to do.
You add advice and scenarios, and you could go this way or you could do this way. And as I said in the intro, thinking outside the box, and you've done that for so many of our clients. So I guess for those people out there that don't really understand, we do have people say to us, well, how do I get finance? What's a mortgage broker?
And how are they different to my bank?
Can't I just go to my bank? So they think, is there a cost? Sort of explain to listeners, I guess, how mortgage broking is different to dealing directly with a bank.
Yeah, that is a common question that I also come across a lot. So I suppose essentially the difference is I'm looking to help prospective buyers, whether that be first home buyers or, next home buyers or investors. Really, they're struggling with where to get started, what to do. There's so much information out there from different banks, different lenders, lots of marketing around, and it just causes mass confusion, which then causes people to freeze and not move forward. So I found just helping them being able to go, okay, let's pick a starting point. Let's identify your goal and let's look at exactly what you're trying to achieve. Not so what you're trying to achieve in the short term, but also in the long term. And then really looking at different lending options. So as a broker, I have access to 40 plus lenders who all have different products and different policies that will suit, different people depending on their circumstances and goals. And I suppose that's contrasted to a bank who can only offer what they have, their off-the-shelf product, that whether it's right or wrong, they're going to try and sell it to that client and say that's the solution and complete the transaction. Rather than looking a little bit deeper and looking at, does the customer need a little bit more advice around what this actually means, and what is an offset account and what is a redraw, and not just taking what they're being told, yes, this is the best for you because we just want to sell this to you, and having that understanding of that that there is fear and hesitation if they haven't done it before. They're not understanding that, what does this mean? What does a loan to value ratio mean? What are all the other factors I need to consider? So I sort of take them through that process and really make sure that advice is tailored to them and they know exactly the reason that I'm recommending a lender and why it's best for them, as opposed to let's just get you the loan and get the deal done.
Well, I guess everyone's different too. Some people they have their own business, some people are on PAYG. You can go to the lenders that are most conducive to getting an approval, right? Because that's the fear. I know when you go for finance, there's always that fear of, oh God, what if I get knocked back and it's going to affect my credit rating? And that's the fear. So
I think that's a really good point. Like, you're setting clients up for success. So you know what is going to put them in the best, stance that they're likely to be approved, not just, whack it together, or as you say with a bank, they've only got their protocols that they can work within and no other selection. So if you're kind of not successful there, then you got to start all over again. And so it's almost like you're the salesperson for the client. You're presenting their case and presenting them in the best light.
Yeah, that's exactly it. It's a really good way of describing it. It was sort of their interim or their representative to the bank and finding out what's going to best work for them. And the other thing that's really, I think, really great as an industry as brokers, we have a best interest duty where we're legally obligated to act in the best interest of our client. And that's not something or an obligation that the banks or lenders have. So I really think it puts us apart in terms of giving, our clients that comfort that they know we have that obligation on top of wanting to help them and the care. But they've got that understanding that that's also there as well.
It's fairly dynamic and changing environment that we're in. So
Indeed.
I guess that's probably an area that we should talk about. Obviously, we're in a very high, interest rate or much higher interest rate environment. You've probably got challenges for some clients with serviceability. We get asked that. We had some clients do a brief with us last night, and even in, a few months, their loan, ability or amount they can borrow has come down, even though their income's gone up since they last. So what are you sort of seeing around, what's the challenges that some of your clients are facing, and even use examples if you want to, but what are you kind of seeing in the market at the moment?
Yeah, definitely serviceability is the number one challenge. People's borrowing capacities have been slashed. There's been 13 interest rate increases in the last 2 years, and that's taken its toll. Banks always add a buffer to the interest rate that they offer. So traditionally that's always been 3%, and that's still in place now. So, a few years ago, banks were calculating repayments for borrowers at around 5.5%. That's now in the 9s and 9.2. So that's obviously nearly double. Straight away impacted people's capacity and purchasing power. Combined with the cost of living going up, banks have also looked at their minimum living expense measure, and that's also increased. So those two combined have really pulled people back. I constantly get clients who will say, 3 years ago we hesitated, we didn't buy, we're ready now, and they're quite shocked to hear what their borrowing
prices really haven't come back to balance out that reduction in borrowing power. They were talking about reducing that buffer. Did that happen? Or
they are? Yeah, well, they are still talking about it. It has been reduced in certain circumstances. Where they're reducing it to 2%, but that's more around refinancing of existing lending rather than taking on new debt. There is still something that the conversation's still happening, but it's my understanding that the regulator is still standing firm at the 3%. That's definitely been a challenge. So with my clients, we've sort of been suggesting alternate options for them. And I think now more than ever, they have to be people really need to be really clear on their strategic direction with their finance and property goals, because that needs to align with what exactly do I need in my borrowing. And what I mean by that is considering other options such as, smaller lenders who might have a higher initial rate but are going to give you more borrowing power in the short term. And that's not something you're going to always have to pay a higher rate. It's until you get to a point in time when we can review that loan. Your circumstances might have changed, the external factors in the market might have changed, and we can move you back to a mainstream lender and get you on a lower rate. But to get you in the door initially, it's something that clients really should consider. There's that opportunity cost if I don't take that option. What's the cost that I'm missing out on that growth or not being able to get into that property? Because the market, of course, will, as we know, just keep moving on.
Yeah, as it does. We have similar conversations with our clients. Sometimes, recently we've had clients that want to get into a particular suburb, and they're on the borderline of being able to afford to get in. And so the compromise is the type of property just to get a foot in the door, because once you have that foot in the door, it's a stepping stone to a next step in the future, because you realise the capital growth, etc., and ride that next price hike. But we're having exactly the same conversations. It goes hand in hand.
You're kind of got your finger on the pulse and are privy to a lot of information that's coming out in the banking sector and finance sector. What's your, and we're certainly not going to hold you to this or any predictions, but what's your feeling for the rest of 2024 and potentially into 25? Rates stayed on hold last time. There was a bit of chit-chat about them potentially going up. We feel like the market's quite sensitive. We feel it when that conversation happens in the media, so do the sales agents. The talk of more percentage, the phone stops ringing for a minute, people tend to freeze. What are you seeing in sort of in the inner circle of that conversation?
Yeah, that happens a lot. We're seeing a lot of fear and hesitation with clients, and just really unsure. They have a strong desire to want to move forward with their purchase, but they're just getting so much bombarded with so much information, so much advice, and media does play a big part in that. I know there was some comments made by an economist earlier this month who predicted another 2 rate increases.
Yes. That was well and truly publicised.
It was splashed all over the news. And I like, economists predicting what's going to happen with the economy and data and around that is very difficult. It's a very tricky game. And obviously economists don't always get that right.
Well, they most often do get it wrong, don't they?
They do. So
if they did, they would be very, very wealthy people. So would everyone else.
Exactly right. So I think I try and look at, sort of a cross-section of some of the more reputable economists and what they're saying, and looking strongly at the data. I'm always there, the Bureau of Statistics announcements, seeing what's coming. And I feel like this month, or the most recent data release we had around unemployment, seeing that increase to 4.1 was the first sign that perhaps we are turning the corner.
Yeah, yes. Because that needs to go up.
That needs to go up, absolutely. And inflation is whilst not going down as quickly as the RBA would like, it's still on the right trajectory. So I think that will continue, and I think I'm prepared to say, I think we'll have 1 rate cut this year.
Great.
We love that. Followed by a few more next year. I think rate cuts are like cockroaches. Once we have 1, there'll be many.
And 1's not going to change the world, is it? But once we get into 1 and 2 and 3 and 4, hopefully it will start to ease some pain, because there are people out there feeling it at the moment. It's been a long, over 12 months now of managing those big payments.
And we're not seeing the distressed sales that were predicted, but we're seeing people cash out in other areas. So investors are selling investment properties. Even people are being more conservative, which I guess you're seeing too, because a few of our clients have erred on the side of caution and not exercised their full capacity. Just waiting to see what's going to happen.
But they're still jumping in, which is good, because we really truly believe that if your personal circumstance is right and you have the ability to buy, to borrow, and comfortably manage those repayments at the interest rate we're at and a couple more, then buy, because we're seeing prices march on.
Yes.
We haven't seen these dramatic price drops that everyone said, the mortgage cliff that was coming and the big crash. Don't have a crystal ball. I don't know what's coming, but what we can speak about is that what we're seeing, and we're not seeing that. When you're comfortable and can manage the payments and a little bit more, buy when you're ready. Because you never hear people say, oh God, I wish I didn't buy that house 10 years ago.
That's exactly
It's pretty rare, isn't it?
Yeah. And we hear that a lot too. We just try and similar message we tell our clients is if you're ready, if your finance ready and you're wanting to buy now, then now is, people say, when's the best time? Well, the best time is, exactly right, when you're ready, when you've got everything lined up and you can jump in now. If you play the game of trying to wait for, government decisions and interest
Time
rates,
the market.
you'll find yourself just always sitting on the sideline waiting for that next thing. And
You mentioned freeze, which was interesting. We have that too, don't we?
Absolutely.
Yeah, that analytical freeze. It's too much overthinking. Yeah.
And then people just get paralysed with it, and there's just so much data and information out there and quite often it's very conflicting. And so, we hear quite often, or we have buyers that come to us and they've been circulating in the market for 2, sometimes 3 years without doing anything, and we help move them forward. And I imagine, so do you have a large portion, or are you seeing a trend at the moment that there's a greater portion of loans that aren't progressing, they're just in a holding pattern?
yeah, definitely. That pre-approval, people are sort of always very keen to find out their borrowing capacity and get things going and get a pre-approval in place. We find, I think this is also based on banks, the big banks data, that less than 20% of actual pre-approvals end up converting to a property purchase.
Really?
At the moment. So it's
What was the percentage?
less than 20%.
Wow.
So it's quite low. And I do find people do get stuck. They sort of, once they get over the hurdle of how to start and we get them into that and the pre-approval, there's a lot of enthusiasm. And then what seems to happen is they do take on board a lot of commentary and a lot of advice from people meaning well, probably close to them, but not necessarily the best people to be giving that advice. And as I'm sure you know, everybody in the country seems to have an opinion on property. And
Everyone loves to just talk
Everyone's
about
talking about
dinner,
property.
breakfast,
Oh my God.
coffee, drinks. Yeah, it's
And there are, you're
hot
right.
topic.
There are so many, we call them egg spurts, that are spruiking all sorts of advice, but it's not qualified advice.
Some of it's
that's-
well-meaning.
Yeah, absolutely. It's very well-meaning and it's coming from the right place, but it's not actually correct a lot of the time, or it's a little bit misguided, unfortunately, or it might be based on a bad experience that they've had formerly. So, we do have to contend with that a lot as well.
We're seeing more mortgage brokers, and this goes back to your 20%. We're seeing a lot more mortgage brokers reach out to us because buyers agents and mortgage brokers, in my opinion, probably should work together more than they currently do. But buyers agents are a fairly new kind of thing. They've been around a while, but it's really sort of, our industry is having a lot of new entrants into it and it's growing. But they go hand in hand. You're having, clients that have got analysis paralysis and don't move forward, whereas we can move people forward much quicker because we know the market, we know what we're doing, and we can expedite that process. So we are noticing more mortgage brokers sort of reaching out, saying, let's chat, we want to catch up, how do we help each other and help these clients move forward? Yeah. Are you finding, more, you're noticing that in the market?
Yeah, definitely. And it's becoming a greater awareness of, the help that a buyer's agent can provide. As you say, it's sort of been a new concept to a lot of people, but I think it's starting to become a lot more awareness and knowledge and widespread. And I always find it just gives, it's not only the, the knowledge and the market and getting access to properties that they might otherwise, but it's also on the emotional side, it's the confidence that you give them. It just creates this in the clients I've had who have dealt with yourselves, and just creates a sense of calm that they know it's going to be okay, and they've got that confidence and just that calm, and they're at ease then about what's going to happen next.
Absolutely. I guess for our audience and people that have never approached the mortgage process, what advice can you give to them about they might be afraid to pick up the phone because they think, God, I don't know what I've got to do, I don't have anything in order. What ideally should they have prepared before they talk to you or a mortgage broker, or they don't have to do anything?
Look, the first thing can just be sometimes a phone call. They don't have to really have that great detail yet. It's obviously, the easiest thing to do is pick up the phone and let's have a chat and see where you're at and what you're trying to do, establishing that goal. Even if you just have some basic information around your income, your deposit that you'll have available or that you can get access to, and, the desired, is this an investment purchase? Is this owner occupied? And is there a plan for future purchases? Just having that basic is a great starting platform just to look at conversations around obviously borrowing capacity, but also, seeing what's possible and guiding them with that. getting into the nitty gritty and, you know, talking about what product suits them and offset accounts and getting their documents, that can come later. But that initial conversation can be, just a very basic one. And I find it's a bit of an icebreaker. Some people do call us and they're always like, oh, phew, a relief, that wasn't so bad. Just to get the ball rolling.
It's kind of the first step, isn't it? And a lot of people that we get feedback from, and something you do extremely well, is there's a fear of all the paperwork. There's so much documentation. And I know even when you have acted for us in our own purchases, you make it so easy. And that's a big plus of working with a mortgage broker, in my opinion, because you're there to help and minimise that, because that stresses people out. Oh, my God, the paperwork that I have to get organised and submit.
It does. And especially as it varies, you know, across lenders, they sort of, well, when I last went for a loan, I needed this and now I'm not sure. Just having that, being able to say, look, that's okay. You don't have to, you know, just deal directly with the broker, not having to deal in with the bank. There's follow-up questions and follow-up information. We'll basically project manage that for you, making it as seamless as possible from, you know, that initial inquiry all the way through to settlement.
That's actually a really good point there too, because having worked with you personally, something that was amazing in our experience, and I know for many of our clients, you anticipate what, knowing the lender and understanding their policy, you anticipate what we may need. So many times you said, look, just preparing you, if in the background you can just have an easy access to this, because I have a feeling they may ask for it, so better to be prepared than not. Or you've said, look, give me that as well, but let's just submit it all, because then they're not going to come back and ask, you know, especially too if there's a time constraint.
Absolutely. Yeah, we do find that a lot when, especially when there is that finance clause and time is of the essence. There's nothing worse than a lender calling up for one little extra piece of paper or information, and then that takes you out of the queue. Then you've got to go back into the queue, just to avoid all of those. And definitely,
because I'm guilty of one of those clients that says, Melissa, it's got to be done yesterday.
I may recall that.
So for the listeners out there, is there a fee to that? Does the buyer pay you a fee for what you do? How does that work for those people that haven't worked with a mortgage broker?
No, that's another great thing about using a mortgage broker. We are basically a free service to the client themselves. So we do get paid a commission from the lender, and that commission is normally the same across all lenders. That does get disclosed to the customers when we make our recommendations. All of that is published to them. But there's no direct cost to. We're also able to access rates at either the same or better than they would get going direct to bank either. So there's no sort of loading.
So kind of, why wouldn't you?
Exactly. Why wouldn't
you? Yeah. And that people don't understand that. Like, it's such a great service. Why wouldn't you?
Yeah. Do you find that, remember back in the day, I can hear my parents saying it over and over again, oh, I'm going down to see the bank manager. Do you still see a lot of that mentality still today? Like, people might be coming to you and, visiting a number of, getting a different opinion. And do you hear that still?
Yeah, I do a little bit, particularly from clients where their parents are generally very involved in the advice or the transaction. They will say the first port of call is go down to the bank, go down to the branch. Normally it's CBA. They had a bit of a corner of the market there with their Dolomite account. Everyone had a Dolomite, so it was a natural progression to go down to your CBA branch. That has shifted a little bit, but we do see it occasionally that, I've been down to the branch. And a lot of the time some people will have gone and spoken to their bank and they'll say, well, I didn't do anything because the bank said that I couldn't do what I was wanting to do, or I couldn't borrow what I was wanting to borrow. And thinking that one bank, one policy, one size fits all, which is not the case. I actually had a client who was looking to buy a property in Windsor in Western Sydney, and she wasn't able to find a solution anywhere. And she came to me very frustrated, really just about to give up. And her situation was extremely unique, but the lender that suited her was actually a small credit union in North Queensland, which she would never have thought of or found. And that was able to get, they were able to give her exactly what she needed, and she was able to get the property that she wanted. But if she'd have just taken the face value of what the banks had said, like, no, it's not possible, she would have just stopped and, given up at that point.
So whilst your business is based here on the Central Coast, do you help clients everywhere?
I do, yes. I was originally based in Sydney. I moved up to the coast in 2019, and my only regret is, why didn't I do it sooner?
That's actually really good advice for a number of listeners, because we get asked that question, will I regret it? I'm not sure about moving to the Central Coast, but there you go.
Yeah, absolutely. Best decision I've made. It's very, very wonderful lifestyle up here, very easily to get used to. And yes, can't believe that I ever used to live in Sydney, actually.
You rarely hear someone say
Yeah.
that they wish they didn't move. It's
Yes.
not that often that you hear people say that they miss the city.
No, definitely not.
Can you, I mean, I know we've had some hairy stories with, getting things across the line at the last minute, but is there can you think of one example, I guess, where it was a bit of a nail-biting experience? I don't know, it could be a deadline, or it could be, just an example to show, the value of how mortgage brokers can get to that deeper level than, rather than a bank and it's on a tick sheet and they just clock on at 9, clock off at 5. Because, there are times you work into the wee hours.
I
of the
remember
morning,
one
we
you
know
did
that.
for us.
Yeah,
You were up till about 3 a.m. that morning.
Through the early hours, yeah.
Yeah, and that was, they were going to not be able to proceed on that property and would have missed that property in the middle of COVID without you. 100%.
Yeah, it's definitely an advantage to have those, not only being able to access the lenders, but having relationships with the right people in those lenders, so you can have those conversations around when things are urgent, when things are critical, to really move things along, and not being, obviously they can't escalate every single deal every time, but being able to have a conversation with someone at the bank and they understand me and say, look, this is the circumstance, this is the client. We really have to get this wrapped up by 5 o'clock or they are going to miss a property. There's no, the banks will just say, oh, tell them to get an extension, and, those throwaway lines, not really understanding the human element, I call it, of it. And sometimes that relationship I can call upon and say, look, no, this is a situation where we really need this done. I did have one that had about 10 minutes to spare on the cooling off and got to 4:51 on the day. And that was very stressful for all involved. I think I took about 36 phone calls in the space of half an hour between talking to, the client and the agent and the bank, trying to get it done, but that we're able to come through and we got the result we were looking for. But I suppose that above and beyond that, for our clients, we know how important it is once they've decided to buy a property and that's for them. We certainly do not want finance or delay of someone being slack, the reason that they're going to miss out on it. So we'll definitely pull out all the stops to get that wrapped up in the time frame required.
Good to have someone on your
vouch
side
for that.
We know
been there. I think we had a record about not that long ago with clients, and it was like literally the last moment.
And we're so proactive in that, you've got that 5-day cooling off period. We're onto it straight away with our clients. But a lot of buyers probably wouldn't understand the urgency of that. They don't really understand that process has got to be put into place really quickly, or potentially you're asking for an extension, which is not always granted, particularly if there's other buyers that want to buy the property. So, yeah, it's really critical time.
Another question that we get asked a lot too, are you seeing more desktop valuations happening today rather than the full inspection?
Why is that? We're seeing it all the time.
Yeah, definitely it's been an increase in that. The banks are moving towards that model. I don't know exactly why the banks are doing that. I suspect it's more of a cost-saving method and a time-saving. So obviously the cost of them to complete a desktop valuation is much cheaper than a full service valuation. It has its pros and cons. Sometimes it can be good because it's very quick, and if the contract price is within the realm of what they think is, the computer says yes, that it all goes through very quickly. You can have a desktop back within an hour. Where it's not so good is it's not sometimes taking into account specific details about that property. If renovations have been done, if extensions have been made. It's taking a generic view of, a standard 4-bedroom, 2-bath, comparing it to every other property in that suburb. Yep. So it can be detrimental in that regard. It can be, of course, valuations can start as a desktop and be escalated to a full service.
So when the computer says no,
that's right.
Then it would most likely escalate to a physical valuation. Is that the process?
That's the process.
Yeah. And we're finding a lot of properties. I actually can't remember the last property that actually had a walk-through valuation. They're mostly desktops. I mean, we're buying these properties well. So maybe they're going, yeah, we're definitely seeing a trend towards that.
And how long does it during COVID, we were asking for an extension on cooling off periods because it was taking them, they couldn't keep up, and it was taking them, into the second week to actually get, the bank valuer out there. Does it still take that long?
It does. COVID was a crazy time for properties. I'm sure you ladies remember well. It was service levels for banks that was very unprecedented. Yeah, things just went out the window and they literally just couldn't keep up with demand. But now we're back in more of I would call, or dare I say, a normalised market. Service levels have gone, much quicker, and generally, they're able to turn that around within that 5 days, unless something, extraordinary pops up. But valuations tend to normally be organised within a couple of days, being honest. Exceptions to that, I suppose, are around if it's a regional area or there's something special about the property. But generally, within a couple of days.
For those listeners out there that are sitting on the fence, not sure whether to buy, not buy, have you got any tips for them to get started? Obviously pick up the phone. But is there anything else that you could recommend that they do, either finance-wise, research-wise, anything that you can sort of say to them, this is where I'd start?
Yeah, definitely. So we've set up a bit of a framework for new clients, which goes through a series of checklists, which we take our clients through. And that's looking at things like looking at their current situation, looking at their current debts, particularly in this current environment. Sometimes the debts that they're carrying, we're looking at opportunities. Could those debts be consolidated? Could you reduce credit card limits? A lot of first home buyers we find do have car loans or car leases. They've sort of thought about that first and then thought, oh, now I want to buy the home. And a $20,000 car loan on average will reduce your borrowing capacity by $80,000. So it does have a significant impact. So we look at if there's any way we can get those paid out or consolidated, or what we can do with that. Looking at things like their bank statements. So their last 3 months bank statements is normally something that a bank would want to look at. The main things that the bank's looking for, or the warnings, I suppose the red flags, is large amounts of discretionary spending. So we normally say to people, if you can cut back, subscription services, Uber Eats, taking out large sums of cash. They're sort of all triggers for the banks who are going to sort of ask you more questions around that. And another tip I would say is with your descriptions in your transaction on your banking, be very careful the way that you word things, and what it might mean to you might be misinterpreted by a bank assessor. As a general rule, if you wouldn't want your mother, if you wouldn't want your mother to read it, then maybe don't use that description in your transactions.
Oh, wow. So there's actually a lot you can do. If they're going back 3 months, there's a lot you can do to prep. And is it true that with your credit card, even if you owe zero on it, but there's a $10,000 limit, that is as if it's full?
That's exactly
assess it that way. So get rid of it.
Yeah, or at least
literally reduce it.
Because, even if you've had a zero and, people say to me, I can sure I've had zero balance, I just have it for emergencies. It doesn't matter. The bank's going to take the conservative position that you'll max it out tomorrow.
A lot of people don't know that.
Yeah.
Some people have multiple credit cards.
They do.
And they think, really just in case that one breaks, I'll use that one. Or, that's really good point. So there's a lot you can actually do to get ready.
Definitely. Yeah, just having that I suppose, that hat on and thinking, how is the bank going to look at these things? The credit cards and the transaction, I think, are the
I want to know
ticket items.
What the transaction descriptions are. Sorry, that's making me nosy, isn't it?
There's only been a few interesting ones, that's for sure.
I bet you get to know people better by the nature of their transaction history. Generically, generally, they'll be looking at things like gambling, that kind of stuff. I imagine wouldn't go down well if there's clearly a lot of online betting, that kind of stuff. Does that go against
online
people?
Shopping?
Inside shopping, Dan Murphy.
Yeah, the online gambling is definitely a big ticket.
I've read that in the media,
using ATMs at clubs, casinos.
Late at night,
They're not a big fan of that.
Times there.
Yeah, so if you're getting your cash out, maybe try
do
and
it in the day.
or not at a club.
They're great tips.
So
would never have
consider.
But I guess everything's documented now, right? There's the history of everything.
That's right. There's nowhere to hide.
There's nowhere
see
to
everything.
hide.
Well, it's interesting. Like, people should put more thought process into what they plan to do for the year. I mean, you even talk to your tax accountant, right? And they'll quite often say, what are you planning for the next, 12, 18 months? Are you looking at borrowing money? And because they try and then also help you manage your finances and your capacity to allow for that to happen. So it's the same, I guess, with borrowing money. People should really give it more of thought about, okay, this year, am I thinking about borrowing money, what for, etc., rather than just going, oh, right, I want to do that. I need the money.
Exactly. And that is one thing with self-employed clients in particular. That's one thing that they can sort of have that planning around and that conversation with their accountant. Because one thing I know to be true is maximising your borrowing capacity and maximising your tax efficiency do not go in hand. So it's not only just planning if this is going to be a borrowing year, having that conversation and planning with your accountant. And lenders have been, that's one thing they have tried to change. One of the policies very heavy around helping self-employed clients. to combat some of the serviceability issues. They've been a lot more flexible and just looking at that 1 year return in isolation. So you really can make those preparations and making sure you're putting yourself in the best light before presenting it all to the bank.
There's a lot to it. Is there a question that I do have for you for the younger people, or even probably not just then HECS debt? Does HECS debt affect borrowing capacity?
It does. Yeah, that is another common question. HECS debt does get calculated obviously on the balance that you owe, and that's taken into account on what the bank calls your debt to income ratio. So that gets added to that overall,
even though it's an interest-free loan,
even though it's an interest,
out of
well,
percent interest.
Yeah, even though that's the case, it is treated as a liability. And that the monthly repayment that you make on that, obviously that's linked to your income.
That's another hurdle, isn't it?
That is
young buyers.
Absolutely. Yeah, it can sometimes push, even if they've got a good income and they're able to afford it in terms of the numbers, just having it push their, what they call the debt to income ratio. If that goes over 6, which sometimes a HECS debt can make it very difficult to obtain lending.
Because the advice has always been, don't pay off your HECS debts. It's only a portion of your wage. It's interest-free. Basically, just leave it there and deal with it. But yeah, you don't often think of those things.
Absolutely, especially with that, if that HECS debt gets to be quite a low balance, and sometimes people will ask me, well, are we better to have put, maximising our savings to show we've got the highest possible deposit? If you've reached that minimum benchmark, you'll find that a lot of times it's better just to pay off that HECS balance and sacrifice a bit of your deposit if you're able to, because that will then be completely removed from the calculations and might free up some more borrowing power for you.
In your opinion, talking about deposits, in your opinion, because lots of people, some people don't have one at all and move things around, in your opinion, to give people the best chance, what sort of deposit do you suggest that they need?
Yeah, a lot of people believe that there's a misconception that they need that 20% deposit and there's no other option. So 20% is a bit of a magic number for banks. It's the number that will avoid paying lenders' mortgage insurance. And for those people who don't know what that is, it's basically a cost that the bank passes on to you to insure them in the event that you default. So whilst a lot of people will say, oh, that's an added cost, removing the hurdle of a 20% deposit can be obtained by paying that lender's mortgage insurance. And I know I did it on my own house. It gets you in. That's right.
I know it. You're going to make that up most likely over the course of owning the property.
If it's especially if it's a long term, buy for you. And 10% is generally a good, if you're prepared to pay the mortgage insurance, 10% is sort of a good benchmark to aim for. I also would say if you're a first home buyer, just checking out what schemes and grants you might be eligible for, because there is the 5% first home guarantee scheme at the moment, which has helped a lot of first home buyers get in, and combined with their stamp duty waiver and only needing 5% has really removed that huge barrier to getting into the property market.
That's amazing. You've added so much. Yeah, I always love chatting because there's always something to learn. I mean, we do this all the time, but we're not mortgage brokers, of course, so it's good to hear your perspective on things. But that's really some great tips for people out there considering borrowing money.
Where can we find you? Where can our listeners find you?
Yes, so I am completely mobile service. So if they reach out to me via email or my contact details, I'm on all the socials, Facebook, Instagram, Maplefly Money. They can reach out to me, and I normally just arrange an initial chat. I can meet face to face or Zoom. And the best thing is, unlike the bank, I don't work 9 to 5. I can work, I can meet you in the evening or even on the weekend. I've even done a few transactions with parents on the side of footy training with their coffee, and I bring the coffee and they bring all the info, and we chat it out while they're there. So amazing, very flexible.
Where does the name Maplefly come from? We know, but we think it's such a beautiful story.
Yes, another question I get asked a lot. So Maple is the name of my 14-year-old Labrador. Now, a bit of a misconception is that we're Canadian. I'm not Canadian, but Maple was named after a holiday to Canada, which we thoroughly enjoyed, and one of our favourite destinations. Lab puppy all those years ago, and named her Maple, and it just seems like a natural name for me to the business. She brings so much happiness and joy to people when they come over. It just seemed like the right fit. And the fly portion of the name, I met my husband online, and I will say back when it was daggy and not cool to mention it online. And his username was Firefly, so I combined the two together. Although my son does ask me, where do I fit in? I was like, we'll have to work that out later.
Oh, that's a beautiful story. Yeah.
Such an awesome story.
Well, thank you so much for joining us today. It's been great, and we really appreciate your time. And I'm sure you've added lots of value to people out there listening. So Yeah, thanks once again.
Been a pleasure. Thanks for having me.
We hope you enjoyed this episode of Unreal Estate. If there is someone you think could benefit from the information that we've shared today, please feel free to share this episode or leave us a comment. We'd love to hear your feedback. We release a new episode every 2 weeks, so stay up to date, hit follow or subscribe, and we'll see you in the next one.